Every market crash looks different. Different villains, different bubbles, different excuses. But look closer and you'll see a disturbing pattern. Before every collapse, before every panic, before every trillion-dollar wipeout, something invisible disappears from the system. Not money, no confidence, not hope. Something far more powerful and far more dangerous. The lifeblood of the financial world. And here's the paradox. Markets don't crash because people panic. People panic because something in the machine has already broken. Today, we're exposing the hidden power that decides every market boom and every market crash. From the Great Depression to the dot-com bubble, from Lehman Brothers to the COVID crash, the world keeps getting blindsided. But historians noticed something strange. Across nearly a century of crashes, across continents, currencies, and governments, the same invisible curve shows up before disaster. A curve that most people never look at. Here's a quick stat. In 26 out of 28 major global crashes, this one metric started collapsing weeks, sometimes months, before markets did. Not prices, not earnings, not GDP. It was liquidity. To understand it, imagine this. You're in a crowded room. Everyone is breathing normally. Life feels calm. But suddenly, oxygen levels drop. You don't see it. You don't hear it. You only feel the panic once it's too late. That is how liquidity works. Liquidity isn't just cash. It's the ability of money to move freely. Think of the financial system as a vast network of pipes. Banks, hedge funds, investors, traders, they're all connected. Liquidity is the water flowing through those pipes. When it flows easily, the system thrives. When it gets stuck, the system suffocates. Let's break it down. A. When liquidity is abundant. Banks lend without hesitation. Investors take risks. Companies borrow cheaply. Markets rise effortlessly. No one thinks about danger. Everyone thinks they're brilliant. B. When liquidity dries up. Loans freeze. Leverage unwind. Credit tightens. Prices drop instantly. This is where the hidden power kicks in. Because the amount of liquidity in the global system is controlled by a handful of institutions. 1. Central banks. The Federal Reserve, the ECB, the Bank of Japan. They control the interest rates, they control the money supply, they control the direction of liquidity. 2. Shadow banking. This is the dark side of the system. Non-banks that lend trillions without being regulated like banks. Repo dealers, money market funds, hedge funds, offshore dollar creators. These players create and destroy liquidity faster than governments ever could. Together, they decide whether markets breathe or choke. It's not random. It's not psychology. It's plumbing. Cold, mechanical plumbing. Before every crash, something triggers a sudden tightening of liquidity. A switch flips, the oxygen drops, and the spiral begins. Example 1. The 2008 crisis. Everyone blamed subprime mortgages, but the real collapse began when repo market liquidity froze. Banks didn't trust each other. Collateral vanished. Liquidity evaporated. Stocks didn't fall because people panicked. People panicked because liquidity disappeared. Example 2. the 2020 COVID crash. Markets lost $10 trillion in a month, not because of lockdowns, those came later, but because global dollar liquidity collapsed. The world needed dollars, the system didn't have enough. The Federal Reserve had to inject $6 trillion just to keep markets alive. Example 3, the 2022 rate hike shock. The Fed fought inflation with aggressive rate hikes. Every hike tightened liquidity further. Bubbles burst, one by one. Crypto, tech stocks, startups, global bonds. When liquidity tightens fast, the weakest parts of the system always snap first. This is the hidden turning point behind every crisis, and it always looks the same. Liquidity falls, credit freezes, forced selling begins, prices collapse, panic spreads, governments scramble. It is a script that has repeated for nearly 90 years. When liquidity collapses, the damage doesn't stay in the market. It spills into the real world. Jobs vanish, savings shrink, currencies fall, housing becomes unaffordable, governments borrow more. Crashes aren't financial events, they're human events. And every modern crisis, from Sri Lanka's collapse to Turkey's inflation spiral, has the same root cause: liquidity stress. The hidden power that begins in the shadows always ends up hitting people in the daylight. So here's the unsettling truth. If you want to predict the next crash, stop looking at stock charts. Start watching liquidity charts, because they reveal the real condition of the system long before markets do. Markets don't crash randomly. They crash mechanically. When the flow stops, everything stops. Understanding liquidity means understanding the true heartbeat.
Now you understand that liquidity is the real force behind every crash in the markets. Now I want your view about liquidity. And don't forget to subscribe to the channel for more knowledgeable sessions in the coming days. So comment and I will answer each of your replies. Till then, sayonara.